Okay, so let's start. We want to start a new topic now. So let me introduce it. We want to do this topic of cash flow. We want to talk about how to do a cash flow statement for the group. Of course, this is not a new topic to you. You must have done it before. It's only that this time we are going to develop it. Especially the aspects of the group, cash flow. But before we look at the aspects of group that affect cash flow, let's remind ourselves how you used to prepare a cash flow statement. Let me remind you how we used to prepare a cash flow statement now. That's what we want to remind ourselves first. How are you preparing a group cash flow statement? Okay, just give me a minute. There's something I want to find out. Okay, just give me a minute. Okay, so let me proceed now. Now, I was saying, how are you preparing a normal cash flow for an individual company? That's what I want to remind you first. Now, listen. You know that there were two formats of preparing a cash flow statement. I am now talking of, I'm talking of how to prepare a cash flow for an individual company, not a group first, an individual company. I'm saying you had to analyze, or you have to prepare cash flow. You know there were two formats. There was what we used to call the direct format, or the indirect method, and what we call indirect method. Now listen, whether you are using the direct method or indirect method, you remember you had to classify your cash flows into three categories. First, you had to start with what you call the cash flows from operating activities. You had to start with what we call cash flows from operating activities. In other words, you had to identify what are the cash flows that were generated from the normal operating activities of the business. You had to identify them, whatever they are. Of course, some will be positive, some will be negative. I'm just reminding you. Listen. Once you identify the cash flows from operating activities and you get a net, some have said will be positive, some will be negative, that net that you got, you remember, you had to push it to the extreme. That means that became the cash flow from operating activity. Listen, if it was a positive amount, you used to call it net cash inflow from operating activities. If it was a positive amount, you used to call it net cash inflow from operating activities. Okay? If it was a negative, you used to call it net cash outflow from operating activities. Okay, so it could be positive or it could be negative. Once you have identified the cash flows from operating, listen, you had now to come to cash flows from investing activities. Cash flows from investing activities. Again, you had to identify what are the cash flows that are being generated by this company from the investing activities of the company. You identify them. Again, some would be positive, some would be negative. I'm just reminding you in an overview. We shall talk about them in details. Once you got the net amount again of all your investing activities, you had to get that net and push it to the extreme. For now, let us assume that the negatives were more than the positives. For now, let us assume that the negatives were more than the positives. So if it's a negative, you used to call it net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. After you were through with the investing activities, you had to go to the last category, which I hope you still remember, and that's what you used to call cash flows from what? From financing activities. Cash flows from financing activities. Again, you had to identify what are the cash flows that our company made from their financing activities. Again, some would be positive, some of them would be negative. Get the net of all of them. For now, let me assume that the net you got of all of them is a positive. Push it to the extreme. If it's a positive amount, you used to call it net cash inflow. You used to call it net cash inflow from financing activities. Net cash inflow from financing activities. Good. Now listen. Once you got the cash flows, the three categories of the cash flows, you had to add all of them. You had to add the cash flow from operating to the one of investing and financing. Get the net of all of the three totals. Get the net of the three totals. Whatever it is. That net again could either be a positive or it could have been a negative. If it was a positive, if you got a positive, I hope you still remember, you used to call it increase in cash and cash. Increase in cash and cash equivalent. I hope you remember that. You used to call it, if it's a positive, you had to call it increase in cash and cash equivalent. If it was a negative, you had to call it decrease in cash and cash equivalent. Good. Then once you did that, you now had to add what we call opening cash and cash equivalent. You had to add what we call opening cash and cash equivalent. Listen, in any question on cash flow, any question you were given on cash flow, I do hope you remember, you used to be given two balance sheets. One balance sheet for last year and another balance sheet for this year. We are doing the cash flow for the current year. So when we are saying you add the opening cash and cash equivalent, it means you had to go to the balance sheet last year, see what you carried down last year, and whatever we carried down last year, that automatically became the opening this year. So you had to come and add that which we are calling opening cash and cash equivalent. Whatever now you get, once you add to the increase or the decrease, That now gives you what we are calling the closing cash and cash equivalent. That now gives you what we call the closing cash and cash equivalent. Good. So this is an overview. This is an overview of how you used to prepare your cash flow statement. I have said it did not matter whether you're using direct method or indirect method. You had to start with the cash flows from operating, come to cash flows from investing, come to cash flows from financing, get the totals of the three, get that net. If it's a positive, you call it increase in cash and cash equivalent. If it's a negative, we have said you call it decrease in cash and cash equivalent. Then we had said you add whatever is the opening cash and cash equivalent, then you get the closing cash and cash equivalent. Listen, that closing balance that you are getting down there should be the same. It should be the same as the closing balance in your balance sheet by end of this year. That's why we are calling it closing cash and cash equivalent. Good. From there now, I go back now that we have looked at the general overview of how to prepare a cash flow statement. Now, we want to ask ourselves, how are you preparing a cash flow statement, or what are the components that you used to use when you are preparing a cash flow and you want to determine the cash flows from operating activities? Now, listen. How to determine the cash flows from operating activities depends on the method that you are required to use. In other words, is it the direct method or the indirect method? Most students are used to the indirect method. And that's what I want to go through first, because it's a common method. It's the most common method among the two. Now, another key point, how you present your cash flows from investing and financing. Investing and financing, the presentation of those two parts is the same. That means it does not matter whether you are using the direct method or the indirect method. For investing and financing parts, the format does not matter whether you're using the direct method or the indirect method. It is the same. The difference between the two methods comes in the section we are calling the operating activities. In the section we are calling the operating activities. That's what I want to go through now. Now, let us use the most common method that most people prefer, and that is the indirect method. Let's start with it. How to present your cash flow using the indirect method. Don't write. We shall discuss, put down everything. But I just want to remind you first of how you used to prepare a cash flow statement. How you used to prepare a cash flow statement. Good. Now, to determine the cash flow from operating activities using the indirect method, you remember you had to start with what we call net profit before tax, or profit before tax. You had to start with the net profit before tax. In other words, go to the income statement of this company, find out what was their profit before tax. Once you got it, listen carefully now, you had to adjust it. You had to adjust it with all the non-cash items. With all the non-cash items that went to the P&L account. In other words, anything you used in the determination of this profit, whatever it is, and that which you used is a non-cash item, use it to adjust this profit. So we normally adjust it with all the non-cash items. Now, I know you know, listen, when we say we are determining the cash flows from operating activities, what are operating activities of a business? It is obvious these are transactions that arise from the general running of your business, normal running of your business. So assuming you prepared your profit and loss, and of course, let me assume I'm doing it in a T form, because you can have a P&L account in a vertical or a horizontal. On the debit side, we normally debit the P&L account with the expenses, you know that. On the credit side, we normally debit credit P&L account with the revenues and the gains. Then you normally compare the two to get what we are calling profit before tax. So let us assume that your profit before tax was 20 million that year. Listen, I have said operating activities are those transactions, listen, are those transactions that are used in the determination of profit. Any transaction that is used in the determination of profit, that transaction is what we refer to as an operating activities. Now listen, with that now, if everything that was used in the P&L account, assuming everything that was used in the P&L account was by cash, meaning the incomes on the credit and the revenues on the credit were all by cash, and the items on the debit, which were expenses and other losses, if they were all paid by cash, listen, then it automatically implies that this 20 million would have been the net cash inflow from operating activities. Remember, we are determining cash flows from operating activities, and we have defined operating activities as those transactions that are used in the determination of profit. And I've said, if everything that we used in the P&L account was by cash, whether that item was debited or it was credited, if it was by cash, then the 20 million profit we are saying would purely be the net cash flow or the net cash inflow from operating activities. But is it true that that is the net cash inflow from operating activities? The answer is no. Why? Because when you as a company, you are preparing this income statement, you know that we normally don't prepare our income statement on a cash basis. No. We normally don't prepare our income statement on cash basis. No. We always use a concept we call accrual concept. And of course, you know, accrual concept says you recognize costs when they're incurred, but not when money is paid. Which means, listen, there could be some things you as a company, you either debited in the P&L account and yet no cash was involved. Or it could be something you took on the credit side as a gain, but no cash was actually received for that item. But as per the rules of accounting, the treatment was right. But now we are not looking at it from the accounting point of view. We are looking at it from the cash point of view. What is the net cash inflow from all our operating activities? That's why once you bring in that 20 million, we are saying adjust it with all the non-cash items. For example, one of the items you could have taken to the P&L account is depreciation. We normally charge depreciation in the profit and loss, but we normally don't pay anything for it. It's an non-cash item. So we are saying, assuming depreciation was not in the P&L account, what would have been the true profit? What would have been the true profit? Would the true profit have been more than 20 million or would it have been less than 20 million? Of course, listen, by including depreciation in the income statement, from the cash point of view, listen, from the cash point of view, we overcasted our expenses. From the cash point of view, we overcasted our expenses. When expenses are overcasted, profit is undercasted. And therefore, to correct this 20 million, we normally come and add depreciation. We normally add depreciation charge so that we get the true profit if everything in the P&L account was by cash. Of course, you know many other things that could have gone to the income statement which no cash was involved. Something else could be, or maybe, impairment. When you impair an asset, it is obvious you never paid anything for that impairment. No. Yet you took it to the P&L account, which is right. So that again must have overcasted expenses, and when expenses are overcasted, automatically profit is undercasted. So you will come and add impairment. You will come and add that impairment loss, whatever it is. Others could be amortization of intangible assets. When you amortize your intangible assets like patents, trademarks, and so on, that amortization you charged was not involving any cash. No. Yet you took it. You come and add. It could be that you as a company, you sold a motor vehicle, and when you sold that motor vehicle, which had a book value, listen, which had a net book value of 15 million, and you sold it for cash of 10 million, you sold it for cash of 10 million, then you made a loss of 5 million. You made a loss of 5 million. That loss of 5 million, you took it to the P&L account. But the question is, did you pay that 5 million? No. It's just a bookkeeping entry. Don't forget, I am not talking of the 10 million cash. Cash, you received it. But when you were closing the books of the disposal, you determined the gain or loss on disposal, and you got a loss of 5 million. That loss of 5 million, you took it to the P&L account, but we never paid anything for it. Good. So we are now coming and saying here, if there is any loss on disposal, again, it's another non-cash expense, which went to the P&L account. Obvious, it made your profit less than it should be, so you add back. What if we sold an asset now, like this motor vehicle, which had a book value of 15, if we sold it for 20 million, then we made a profit on disposal of how much? 5 million. We made a profit of 5 million. That 5 million, you took it to the profit and loss, as an income or a gain. But did you receive the 5 million? Don't forget, I'm not talking of the 20. 20 is what you received. But I'm talking of the 5 million. Did you receive it? No. It is just a bookkeeping entry. It's just a bookkeeping entry that you made in your income statement. Good. And therefore, we are saying any profit on disposal, you took it to the P&L account as a gain. If it was not there, would my profit have been more than 20 or less than 20? It is obvious my profit would have been less than 20. Why? Because by including that gain on disposal, we overcasted our incomes. When incomes are overcasted, profit is also overcasted. You minus. Another example of a non-cash item could be provision for bad debts. Provisions for bad debts. But when it comes to provision for bad debts, listen, there are times provisions for bad debts could be added in this list, and there are times you could be required to deduct it from this list. So the question is, when do you add the provision for bad debts? When do you deduct? When do you add the provision for bad debts? When do you deduct? Let me just remind you. You all know that provisions for bad debts can be sometimes be a gain or it can be a loss. Using an example, suppose your company prepared an account called provision for bad debts, and by the beginning of the year, your provision for bad debts was 10 million. Then from the additional information in that question, you are told maintain provision for bad debts at 8 million. So you came and carried down your provision for bad debts at 8 million. So if the provision by the beginning was 10, and by the end of the year you are carrying down 8, it means this year you must have taken to the profit and loss how much? 2 million. Did you take that 2 million to the P&L account as a gain, or did you take it to the P&L account as a loss? It is obvious you took it to the P&L account as a gain. Why? You know this, that whenever there is a decrease in provision, that decrease is considered as a gain. So in your income statement, together with that profit on disposal, you added that 2 million. When you added the 2 million on the credit side of the P&L, it made your profit more than it should be. Yet you never received that 2 million. That's what we are saying. So in that case, you will come and do what? You will come and minus. Alternatively, what if you carry down provision for bad debts of 18? You began the year with 10, then as per the question, you are now carrying down a provision of 18, meaning during the year, you took to the profit and loss how much? The balancing figure is normally 8. So if you took 8 to the P&L account, of course you have credited provision, you must have debited P&L account. You must have debited P&L account by 8 million. That 8 million, you recognized it as a loss. Don't forget, you had a loss of 10. You know, listen, you know provisions for bad debts, a provision is an anticipated loss. When you say provision, we normally consider it as an anticipated loss. So by the beginning of the year, our anticipated loss was 10 million. Come the end of the year, our anticipated loss had increased to 18. So in the current year, our loss had increased by 8 million. So that 8 million, you considered it as a loss. If you considered it as a loss, you took it to the P&L account as a debit. When you took it to the P&L account, did you pay anything for that 8 million? The answer is no. So, you recognize a loss, which is not a cash item. It made your profit less than it should be. When expenses are overcosted, remember you included it among the expenses, and yet you never paid anything for it. So it means from the cash point of view, your expenses were overcosted. When expenses are overcosted, profit is undercosted, and therefore this time you would have been required to come and add back. Good. Now, I want to challenge you now. I want to challenge you because this is not the first time you are doing this. This is not the first time you are doing this topic of cash flow. Now listen. Among the non-cash items, among these non-cash items I've given, there is another one. There is always another one. You will always get it in any question you ever did. I have not quoted it. But I always tell my students that when you go to the exam room and you are given a question on cash flows, listen, there are two non-cash items that you will never miss. And why should you lose the marks for them? One, of course, one should never lose marks for the profit before tax, because that is something you just pick. Why should you lose it? Then I'm saying, among the non-cash items, there are two non-cash items which will never miss in any question you have ever done. Whether it is in this advanced level or at the previous levels, two non-cash items never used to miss. One of them is depreciation. There is one more. I have not quoted it. But I would wish somebody would remind us, what is this non-cash item that you ever used it in any of the questions that you ever did? These others, which we are talking of, impairment, amortization, loss on disposal, profit on disposal, provision for bad debts. Even bad debts, by the way, they are non-cash items. Even bad debts, they are non-cash items. When you write off a bad debtor, did you pay that amount? No. When you write off a bad debtor, you just credit data and you debit bad debts. That bad debts goes to the P&L account. It's not something you paid. It's a non-cash item. Come and add. But still, I'm looking for another one non-cash item, which you will never miss. Somebody remind me. You chat and remind me, what is this other non-cash item that will never miss in any question? I have literally not listed it because some students forget it. What is this other non-cash item? Chat and tell me what you think is this other non-cash item that we have not quoted. Yet it is ever there in any question. No, not income tax. Income tax comes down there. And it's not an non-cash item, it's what you paid. Income tax, unachukuanga tax paid. I'm talking of a non-cash item. A non-cash item. Somebody else, what among these non-cash items were you ever or will you ever get Okay. Okay. Sawa. Good. At least there are people getting now. I can see. Let me talk about it. I don't know who is right there, but let me mention 2 people have got it. Now the third one is there. I think the third one is there. Not good. Goodwill we have already talked about. Goodwill is about impairment. Impairment of goodwill, that's the one I'm talking about. I'm not talking of goodwill as an asset. Listen, we are not talking of goodwill as an asset. We are talking about impairment of goodwill. I can see several people have listed goodwill, but I'm talking of impairment of goodwill. Goodwill on its own is an asset, but we are looking for non-cash expenses. So when you impaired your goodwill, that's what we are talking about. It's about that impairment loss. Good. Now, there is somebody who has mentioned it, I think 3 people, and I want to demonstrate it first before we put it there in that list. Listen. I want to demonstrate it first so that I just remind you the accounting principle, which you should always remember. You must have done it in section 1, financial accounting. It's a concept. Listen. In financial accounting 1, you did a topic called company accounts. Company accounts. In that topic of company accounts, the examiner used to give you a trial balance like this. I am assuming some figures. It gives you a 10% debenture, maybe 500,000. Within that debenture, or within that trial balance, it gives you interest on debentures, 40,000. Then you used to be told, prepare an income statement or profit and loss. So the question is this: when you were given such a trial balance, remind me, how much were you taking to the profit and loss account as the amount of the interest? When you are given such a trial balance, I want you to chart and give me the answer, assuming you're given a trial balance, and in that trial balance, you have a 10% debenture, 500. Within the same trial balance, there is interest on debenture. Then you are required to prepare an income statement and a balance sheet for that company. So the question is, how much would you take, or were you taking, the P&L account as the interest? You chart and give me the answer. I have used simple figures so that you don't bother a lot. How much were you charging in the income statement? How much were you charging in the income statement? When you are given a trial balance of this nature, and the question used to tell you, yes, good. At least Felix has got it. Listen. Thank you. Good. Many people have got it. Now, listen. We normally prepare our income statement on a basis we call accrual concept. That is the basis we use. Listen, we normally prepare our income statement on accrual basis. Accrual basis says you recognize costs when they are incurred, but not when money is paid. You recognize costs when they are incurred, but not when money is paid. So when you are doing such a question, listen carefully now. Whenever there used to be a debenture, you had to take the percentage of the debenture on the value of the debenture. That is what you had to charge in the income statement. Your company has issued a debenture worth 500,000. Every year, the company is supposed to pay the debenture holders their interest at 10%. 10% of 500,000 is 50. That's what you are supposed to charge in the profit and loss. Listen, then when you are doing the balance sheet of such a company, then it is at this point in time, when you are doing the balance sheet, that is the time you had to ask yourself, do we owe anything? Do we owe anything to the debenture holders? As per the trial balance, we have only paid them 40. As per the trial balance, we have only paid them 40. But what was the charge for the year? The charge for the year was 50. So if I've only paid them 40 and I'm supposed to pay them 50, then as a company, we have not paid them another 10. That 10 is what you used to take to the balance sheet as a current liability by the name of debenture interest owing of 10 million. Good. Now, so what I'm trying to say is this. Now look at this income statement. In this income statement, you took to the P&L account 50,000. But did you pay 50,000? No. You only paid 40,000. So this 50,000 is just a bookkeeping entry. It's not something you paid. No cash was involved for this 50. I am not talking of the 40. I'm talking of the 50 that you took to the P&L account. You took 10% of the value of the debentures, and that's what you got as the charge for the year. When you took to the P&L account the amount of 50, that being a non-cash item, the 50 is what you took to the P&L account, is an non-cash item. And therefore, that is also another non-cash item that went to the P&L account. Listen, there are times when also the examiner in company accounts used to give you another trial balance of this nature. When you are given 10% debenture amounting again to 500, and in that trial balance there is nothing like the interest. You're just given 10% debentures in the trial balance, and in the same trial balance there is no interest. The question is, do you still have to charge interest in the income statement? Yes, you still have to charge it. How much? To the profit and loss, you had to charge how much? 10% of 500. That is 50. Because that's the rule of accounting. You recognize costs when they are incurred, but not when money is paid. So as per this trial balance, we have paid nothing for debenture interest. So, but does it mean we should not charge? We should still charge debenture interest. So, which is 10% of 500, which is 50. That must go to the P&L account. When I'm doing the balance sheet for this company, then I have to ask myself, do I owe the debenture holders anything? The answer is yes. How much am I supposed to pay them? 10% of 500, 50. Have I paid them? No. So that same 50 will go to the balance sheet again as a current liability for debenture interest, 50. So you can see from these two cases, what you took to the P&L account for interest is not what you paid. No. It is not what you paid, but it is what was the charge for the year, whether you had paid it or not. Now listen. So we are now saying another example of a non-cash item, which one should not forget. Now listen, which one should not forget is what we are calling finance cost. Let me squeeze it somewhere here. Finance cost, which in our case, for these two cases, it is the 50. Now, that finance cost may be interest on loan, it may be interest on debentures, it doesn't matter. Whether it's loan or debentures, it doesn't matter. But It is what we are saying, the charge for the year for interest. So I can see several people go to that proposal. So listen, two things will never miss in any question you did earlier or you will ever do in this topic. 1, depreciation. 2, finance cost. I have said you take the finance cost charge, not what you paid as 40. No. That 40, listen, that 40 has its own other place in the cash flow. I am talking of the 50. Yes, I know you paid 40. Does that 40 affect cash flow? Yes, it will affect cash flow somewhere. Of course, I can even just say it now. Among your financing activities, you paid 40,000 because you borrowed finances. So among the financing activities, when you are paying the financiers of the company, their return, that return you pay to them should be classified as a financing activity. So in the cash flow, among the non-cash item, it will be that 50. Listen. Then when it comes to financing activity section of the cash flow, where we shall now come and say interest paid. Interest paid. How much? 40. So listen. So the charge for interest, you take it as an non-cash item, and the interest paid goes to the cash flow as a financing activity. Why? Because you are paying the financials of the company. Good. So let me assume for now that we have identified all the non-cash items. For now, let us assume we have identified. In fact, we have mentioned the majority, and I have emphasized that the two most common ones you will never miss is depreciation and finance cost. Listen, for finance cost, again, listen, I've told you, anytime the examiner gives you a question on cash flow, that question will give you the income statement for the year, and it will give you two balance sheets, one for last year, another one for this year. So you will go to the income statement. You will go to the income statement and find out what is it that we charged in the P&L account as interest. What is it that we charged in the P&L account? So that 50, it is something you just pick from the income statement, not to calculate. You just pick it from the income statement. Good. What you may be required to calculate, listen, what you may be required to calculate is the 40. Because sometimes they don't tell you how much they paid. Sometimes you have to calculate it. But we shall see later how to do it. But the 50, you will see it in the income statement as the figure called finance cost or interest charge. Good. Now we move on. Now, assuming that's all for the non-cash item, listen now, you get the net, and I hope you remember that net is what you used to call, cash flow before working capital changes. That net is what you used to call cash flow before, listen, cash flow before working capital changes. That's what you used to call. Once you take the profit before tax, you have adjusted with all non-cash items. The net is called cash flow before working capital changes. Of course, you know working capital items are current assets and current liability items. So you bring the changes in the working capital. Let me include one. Increase in stocks. You analyze your balance sheet last year and you find the stocks last year were 10 million. By end of this year, our stocks are 30 million. For stocks to have gone up, what could have happened? It is obvious. For stocks to go up, we as a company, we must have acquired some more. That is an outflow. Then you analyze the data. You come and say, yeah, maybe there's decrease in data. Let me assume so. Last year, our data were 10 million. This year, our data are 8 million. For data to go down, what must have happened? They must have paid us. In other words, we must have received from data. So when there's a decrease in data, that is obviously an inflow. Now, listen. Another component of current asset is what we call cash or bank. Listen, I know you know we normally don't analyze cash at this point in time. We normally don't analyze cash here. Though it's a working capital item, we normally don't analyze it here. No. Where do we normally analyze it? I told you, down there when you are finishing the cash flow, there is a place you called add opening cash and cash equivalent. So whatever cash was given to you last year, that is the one you normally add down in the cash flow. So you don't use it as part of the working capital. No, because it has its own specific place in the cash flow. Listen, same to bank. Let me assume now that you have analyzed your current assets. You go to your current liabilities. Among your current liabilities, I want to assume the only one is creditors. And when you analyze creditors, you realize maybe there was a decrease in creditors. Whatever it is, what happened? For creditors to go down, we must have done what? We must have paid them. Last year creditors were 10, this year creditors are 8. We must have paid them that 2 million. It is an outflow. Good. Listen, once you are through, let me assume those are the only working capital items now. Let me assume those are the working capital items now. So once I'm through, I get the net again for them. Whatever it is, it could be positive or negative, whatever it is. Listen, then from there, you had to come and minus what you used to call tax paid. You had to minus tax paid. Whatever we paid for taxes this year, that is you minus. Once you minus tax paid, listen, the net you get is what you push to the extreme. Whatever it is, you push it to the extreme. That is what I was telling you. That could be either a positive or a negative. If it's a positive, which I want to assume, we shall call it net cash inflow. We shall call it net cash inflow from operating activities. Net cash inflow from operating activities. So we are through with the determination of the cash flow from operating activities using the direct method. Do we less tax paid before we less interest? Okay, now listen. I can see you can remember something. Felix, listen, I can see you remember something. Now, when it comes to interest paid, there are some companies that consider interest paid as an operating item the interest paid. I'm not talking of the charge, the interest paid. There are companies that consider it as an operating item, and there are companies that consider it as a financing item. The accounting standard allows you to choose between the two. If you choose as a company that you're going to use it as an operating activity, then together with the tax paid after that, somewhere there, you also have interest paid. But if you take it that you are paying interest on financials, to the financials, you are paying interest to the financials, then you consider it as a return to financials, and therefore it will go to financing. So Felix, you are allowed to use it in either of the two, that interest. Either you might use it together with the tax there, that way you are considering it as an operating. Because they are saying maybe you borrowed to finance your normal operations. Somebody could argue that you borrowed to finance your normal operations. So that interest is a normal operating item. That's one argument. Others argue that you are repaying the financiers. Financiers, if I'm paying them their return, then it is financing. Just like, listen, just like you pay shareholders their dividend. We normally don't bring dividends paid here. But if you pay the shareholders their dividend, don't forget, shareholders are also financiers. So whenever you pay them their dividend, we normally take it as part of financing. Dividends paid. Are you there? So Felix, I hope you have understood that for interest paid, you can choose where you want to use it. Either as operating, that's okay. You put it together with that dividend, tax paid, or you use it as part of financing. Okay? I prefer using it as part of financing, but if you are used to paying it as part of the operating, no problem. You will be marked right. Okay? Good. Let's move on. So we are now through with the first category. We are now through with the first category of the cash flows. We now go to the second category, and that is cash flows from investing activities. That's what we want to talk about now. What are these cash flows? Cash flow from investing activities. Cash flows from investing activities. Now, by definition, investing activities, you remember, because you must have been told what are investing activities. Investing activities, listen, are those transactions that affect any fixed asset. Any transaction that took place in your company this year and affects a fixed asset, that kind of a transaction should be classified as an investing activity. Something that took place in the current year and affects fixed assets, whichever fixed asset. For example, you could have bought a motor vehicle. So when you paid to buy that motor vehicle, that is an investing. So we can come and say one example of a investing activity is purchase of fixed assets. Whenever you purchase a fixed asset, whichever the asset, that is obviously an outflow. Listen, you could have also sold your machinery for whatever much. Still an asset you are selling. So you come and also say sale of fixed assets, whichever the fixed assets you are selling. Listen, sometimes you go to the balance sheet of the company and you find, listen carefully, and you find now among the fixed assets there is investment. among the fixed assets, there is investment. Maybe you are given from the balance sheet last year, 2020, the investment was 5 million. From the balance sheet this year, 2021, the investment is 6 million. So when investments are increasing, it is obvious you could have bought some investments. And those investments are among the fixed assets. I've told you, investing activities are any transactions that affects a fixed asset. So if there was purchase of investment, then it's still an investing activity. Come and say a purchase of investments. Whatever it is, that's an outflow. Alternatively, you could have sold part of your investment, no problem. When you sell part of your investment, it is an investing. Listen, I am not saying you are selling those investments that are among the current assets. A company could have an investment which is a current asset, meaning it's a short-term investment. I am talking of those investments among the fixed asset. That means they are long-term investments. When you buy them or you sell them, they are classified as investing activities. Listen, still under investing activities, now that I've talked about investments, listen, I have also told you anything relating to fixed assets is investing activity. Any transaction affecting a fixed asset is an investing activity. Listen to this now. Suppose these investments that you have gave you some income in form of dividend income. So any investment income that you as a company you are receiving, that investment income should also be classified as an investing activity. Any investment income, it's an inflow. You could be receiving dividends from your investments. That is an income to you. Okay? And because you are receiving it from a long-term investment, it relates to a fixed asset. So some students forget that investment income. Some students forget that investment income as far as investing activities are concerned. It is not an operating activity. Listen, you are receiving an income from your investment. It is not an operating activity. It is an investing activity. Is that investment income? Yes, I'm saying investment income should be considered. Njiru is saying if you have investment in a joint venture, Njiru, I have said when I was introducing the topic that I am introducing how you used to prepare a cash flow from an individual company. I have not touched anything as far as group is concerned. Are you there, Willis? I have said when I started that I am reminding you how you used to prepare a cash flow for an individual company. Once we are through with the concepts of an individual cash flow for a normal company, now we develop it and ask ourselves, what if this company has a subsidiary? How does it affect their group cash flow? What if this company had an associate? How does it affect their cash flow? How does it affect them if they had a joint venture? But for now, I am reminding you what you used to do in financial accounting on how to prepare a cash flow for an individual company. Once we are through with the concepts of an individual company, you have understood them, then we now develop developing the topic will be much easier because there are not many things that come into the group. No, it's only associates and maybe that joint venture, which is the same treatment. And the another thing that we normally affect in the group is how to treat what we call non-controlling interest. Non-controlling interest. So when it comes to group, there is very little to be added. Only 2 areas to be added, and then you do a question using the concepts that you have learned, which means the most critical part is what we are doing now, because that will take 3/4, more than 3/4 of your marks. It's only 2 areas that bring a group aspect. How do you treat associates in cash flow? How do you treat joint ventures, which is the same as associates? How do you treat what we call non-controlling interest? But those ones, I'll talk about them later, once you have understood the concept of normal cash flow for individual companies. Good. Now listen. So I was saying, most students forget and they use the investment income as part of operating. Don't use it. It's an investing. For now, listen, for now, let me assume again that you have determined everything from investing. Normally, investing doesn't have many. I've told you, these are only the changes that took place in your company which affect your fixed assets. Okay? Anything affecting your fixed assets, either you are buying it or selling it, whatever it is. And if you had an investment among the fixed asset and it gave you an investment income, that is an investing activity. For now, let me assume those are the only ones. Once I do that, I get the net of all of them. I told you, whatever is the net, push it to the extreme. For now, again, let us assume that we had a negative, that the positives were less than the negatives. In other words, the negatives were more than the positive. So if it's a negative, now you will call it net cash outflow. You will call it net cash outflow from investing activities. Net cash outflow from investing activities. So we are through with the second category of the cash flows now. We want to go to the third categories of the cash flows. We want to go to the third categories of the cash flows. And that's what we call cash flow from financing activities. Cash flows from financing activities. Okay? Now, what are financing activities? Financing activities are those transactions that affect the finances of the company. Any transaction affecting the finances of the company, that transaction we normally classify it as a financing activity. Most common ones could be issue of shares. Maybe during the year as a company, you issued shares, that's financing, it's an inflow. Maybe during the year, you as a company, you issued some debentures, that's an inflow. Maybe during the year, you as a company, you repaid part of your loans. Loans last year were 5 million. This year, the loans are 2 million. You have repaid by 3 million. You come and see your loan repaid. Whatever it is. Now listen. For now, those are the major finances that can be raised by a company. Shares, debentures, and loans. So you have analyzed them. Listen. Then I told you, any return you are paying to the financiers, any return you are paying to them is normally considered as a financing activity. So one group of financiers are the ordinary shareholders. So if you paid them dividends, we normally come and say your dividends paid is part of financing. You minus. We paid the venture holders or the loan providers, we paid them some interest. So whatever you paid them as interest, that interest paid is considered as financing. Good. So we have paid the financiers their returns. We have paid them their returns. Once you pay them their returns, get the net of all the financing, push it to the extreme. Let me again assume this time that the net is a positive. We are assuming that the net is a positive, push it to the extreme. If it's a positive, we call it net cash inflow. We call it net cash inflow from financing activities. We call it net cash inflow from financing activities. Good. Now that we are through with the three categories, I told you, get the totals of those three categories. Get the totals of those three categories. That is the operating at the start, the investing, and the financing. Once I get the total of the three, I have told you a short while ago, that amount could either be positive or it could be a negative. For now, let me assume it's a positive. You come and call it increase in cash and cash equivalent. Once you do that, I told you, you now come and add what we are calling opening cash and cash equivalent. Whatever it is from the balance sheet last year became the opening this year, that's what you add. Then whatever you get down here should be the same as the closing cash and cash equivalent. Good. So I've reminded you how you used to prepare a cash flow statement for an individual company using a method we are calling the indirect method. I've also told you that there is always another method which you used to call the direct method. I also told you the direct method and the indirect method are the same when it comes to investing and financing. The only two methods differ when it comes to presentation of the investing activities. Good. Now, what else? I don't know whether we need the format. Ama we move on. Do you need to copy down the format? Ama you are okay with the format? Do we need to copy down the format? Ama you are okay with the format? We go on. Do you need the format? Ama we go on. Do we need to copy down the general format? Do we need to copy down the general format? Ama you are okay? We move on. We go on. Okay. Somebody says we go on. We go on. Go on, please. Sawa. Okay. I hope nobody will have an issue when I'll be doing a question and you told me. I hope nobody has an issue. Or what you could do. Maybe what you could do is this. Sorry. If some of you feel they might forget, you can take a screenshot. If you feel you will forget, though the format is not clear kabisa, but you can take a screenshot. Otherwise, if we were to put down the format, we would write everything slowly. But what you can do, if you feel you will forget, take a screenshot. Take a screenshot You can take the screenshot. Most important part in that section I've told you is the finance cost and depreciation. One should not forget them. So you can take that screenshot. Then I roll it up so that you can copy later, slowly and clearly. I was just rushing to remind you. Okay. So let me now move on. Let me scroll. I hope you have taken a screenshot, because we have agreed we move on. Take that second part of the screen. Take that second part of the screen. You can take that screenshot. Take that screenshot so that when you have enough time on your own, you will sit down. If you think you'll forget, not a must that you have to have it as part of your notes. Some of you could remember the format even as we shall be doing questions. Okay? But if you feel you need a detailed, because some of the questions don't have all the non-cash items, for example. We have listed many, but it's good to know a variety of the non-cash items, especially those ones. Okay? Let me roll up. I hope you have taken the screenshot now. So let me roll the last part. Not the last part. Seems it will not fit. Seems it will not fit all of it. So take that screenshot again. Then I come and finish down there. So in terms of investing, I've said those changes affecting fixed assets are the ones you consider. Then I've also told you, do not forget investment income. That's important. Students forget and take it as part of operating. It's not an operating item. No. Once you have taken that screenshot, I can now move on. That's the last part. That is the last part. You can take a screenshot of that last part. Then we discuss. I remind you, listen, I want to remind you the second format. That is the cash flow from operating activities using the direct method, Okay. I hope you are through with the screenshot. Now listen. So let me remind you, because you must have done again. Let me remind you how you used to prepare cash flow. Don't write again. This is cash flow from operating activities. But now we are using direct method. Now, if you remember, to determine the cash flows from operating activities, you only needed 3 figures. You only needed 3 figures. 1, 2, and 3. Listen, once you got those 3 figures, you had to get the net. Then you had to come and say your tax paid, just like we did down there. Once you got the tax paid, you get the net, push it to the extreme, and that would be your net cash inflow net cash inflow from operating activities. So what I want you to remind me are, what are these three things that you had to use in the determination of the cash flow from operating activities using the direct method? What are they? What are those three things? Two of them you can see I've put them in brackets. One is a positive amount. The other two are normally negatives. So remind me, what are the three items that you had to use when you were determining the cash flow from operating activities using the direct method? Yes, you chat and tell me one of them. You must not go through that in a specific order. No. But maybe you remember the third one, not the first one. No problem. I just want to see whether you can remember. Whether you can remember any of the three things. No. Gilbert, no. Profit on disposal is an uncash item. We are looking for cash. No. Well, don't confuse. Felix, I've talked about non-cash items in, listen, non-cash items in the direct method. Here, we don't show non-cash items here. No. I am not saying you don't use them, but you don't show them here. Oh my. Nobody can remember any one of them. Payables. Payables, somebody else. At least you are closer. Good. Somebody has given us a majority now. Good. Now, let me mention them. The first one, you have to determine. And by the way, listen. The only thing or the only bad thing about this method, which is the direct method, the examiner will never give you any one of these three figures. Normally, it's your responsibility to calculate them. Normally, you are never given any one of the three that we are looking for. No. Normally, it's your responsibility to calculate them. The first amount is what we call cash received from customers. Cash received from customers. Listen, I am not saying cash received from debtors. Yes, debtors are customers, but they are not the only customers. Listen, you could have sold some goods on credit and you receive from your debtors. Those are still customers. You could have sold your goods in cash, on cash basis, to your customers. So when I'm saying cash received from customers, we are asking ourselves, from all our customers, whether they are cash customers to whom we sold goods to, or they are credit customers who paid us later, how much did we receive from all of them? That's why we are calling it cash received from customers. That's one. Number two, you also need to determine what we call cash paid to suppliers. To suppliers. I am not saying, listen, I am not saying cash paid to creditors. No, I'm saying cash paid to suppliers. Because if you buy goods on credit, you will pay your creditors. They are part of your suppliers. But you could have also purchased more goods on cash basis, you as a company. So you still paid your suppliers for the goods you bought by cash. So when I say cash paid to suppliers, we are saying cash paid to all our suppliers. Whether they are cash suppliers who supplied goods to us and we paid them in cash, or they are suppliers we bought from them on credit first, then we later paid them, it does not matter. What is it that we paid to all our suppliers? That is something you have to calculate. Cash paid to suppliers. Number three is what we call cash paid for services rendered. Services rendered. Some books will call it cash paid to employees and services rendered, no problem. But what I mean is this, for the last one. You as a company, there are some services you have been given. For all the services that you have been given by whoever gave you the service, what is it that you paid them? Employees gave you a service, you paid them salaries. Kenya Power gave you a service, you paid them for the electricity. And many others. What did you pay for all the services that were rendered to you by the service providers? Whether they are employees and other service providers like Kenya Power, landlord gave you a service of the building, whatever. What is it that you paid for all the services rendered to you as a company? That's what you need to determine. Now, listen. The only issue I've told you is that nothing of these three figures will be given to you. It is something you must calculate it. Cash received from customers, we shall ask ourselves later, how do you calculate it? Cash paid to suppliers, how do you calculate it? Cash paid for services rendered, how do you calculate it? That's the only challenge with this method, that nothing is for free. You have to calculate it. It's not like in the other method where I can get some marks for free. I can get the tick for profit before tax. I can get a tick for depreciation. I can get a tick from the finance cost. And maybe somewhere I can see the question says they sold an asset and made a loss on 10 million. Sold an asset, made a loss of 10 million. I can see that's a loss. Maybe I read somewhere that during the year they impaired the goodwill by 2 million. That I know is impairment. For the other question, at least there are some non-cash items you can guess and pick from the question. But for this one, you must calculate all of them. Good. Now, listen. We don't have time to talk about each of them. And I also wanted to talk to some new students, especially because this was a free class today. Again, this was a free class. So I just want to talk to the new students. For my normal students, you have all the information. But for the new students, let me mention one or two things, especially for those who are new today, because today was a free class. Now listen, for the new students, if you wish to continue with us on advanced financial reporting, we normally have two classes. We have early morning classes. This is early morning classes. and we have evening classes. Our early morning classes start from 5:30 to 7, 5:30 in the morning to 7 a.m. every Monday, every Wednesday, and Friday. That is the timing for our early morning classes. For the evening classes, they are from 8 p.m. to 10 p.m. every Monday, like today, Wednesday, and Saturday. Those are the timings for the evening class. One can also buy the videos, which we normally call pre-recorded videos. You can also buy what we call pre-recorded videos. Maybe you feel you can't attend a live class, but you want the videos of the same subject. You can buy what we call pre-recorded videos. We are charging 4,000 shillings for either the class or the pre-recorded videos. Now listen. The new students, listen. The good thing about our system is, even if you miss a class, you can still go back to the group where the link was posted and be able to watch the video at your own free time. Assuming on a Saturday, you are not available, you had a function when the class was going on, does it mean you have lost that class? No. You can still go back to the group where the link was posted and be able to watch the video at your own free time. Or maybe I could have taught you and you still feel you want to refresh that question or that video, you want to review it again, just go back to the group, click on the video you want to listen to again, and you'll be able to listen to it. That's a good thing about our system, which means whether you buy pre-recorded videos or you go to the normal class, you can still get the videos that you have or the ones you want. It doesn't matter. Whether you buy pre-recorded or recorded or live, you can still get the videos of any class that you will miss, you can still get. Okay? Good. Now, some of you have friends who are doing financial reporting. We are also offering financial reporting, and the classes there again are from 8 p.m. to 10 p.m. every Tuesday, Thursday, and Friday. That is the timing for financial reporting. We are also doing financial accounting of foundation level. That is what used to be in section 1. And the other financial accounting of ATD. We are still doing it. There are some who are even asking for financial accounting of CIFA. It's the same syllabus with the financial accounting. Okay? So for those ones, again, we are also teaching those financial accounting. So if you have somebody who wants to do accounting, let him do that. Okay? Now listen. I have told you the charges are 4,000. We normally accept payments in installments. I would urge you, go to my YouTube channel. And subscribe. Go to my YouTube channel and subscribe. Subscribe to that channel. The channel is called CPA Joseph Njuguna. Please subscribe so that you may get notification for any new videos that are published to the public. Because not all videos go to the public. No. I think I've mentioned almost everything that you need to know. Somebody's asking a question. Guys, listen to Njuguna. He is the best. I have passed through his guidance. There is somebody called John, meaning, are you through with CPA, but you just wanted to listen to the class? John is saying, listen to Njuguna, he is the best. I have passed through his guidance. So does it mean that, John, you are through with CPA, but you just wanted to listen today for the free class? Oh, yes. I hope you have gained something. I hope you have gained something, though you are not doing exams. Like your friends who are in 8, right now they are doing exam. Those who have joined, maybe they are doing it for the sake of exam. You wanted to learn. Patrick, I would like to join, but much behind. Another point. Okay, fine. I have forgot to mention that point. I have so far covered about 3 topics, but you can still get the videos of the previous classes. That should not panic you, Patrick. If you want to join, call me. By the way, I have not even mentioned my number. I almost forgot it. Call me 0722 65 8875. Call me on that number. 0722 6588. If you want to join, you can get the videos of the previous classes. I hope, John, you're okay now. No, Patrick, sorry. You are saying much behind. You will catch up. You are doing exams in December. We have a few topics we have covered, not much. Okay? So if you want to join, call me on that number, 0722 65 8875. Good. I hope I've raised all the concerns. Nobody has any other question now. I hope I've also not forgotten something that we have said. That's my number. We have given the timings of the early morning and the evening classes. We have said if you miss a class, you can still watch the video. How to pay? Just send the money to this number. Somebody else is asking how to pay. Just send the money to this number. Then you send me a text stating that you are paying for this class, either early morning or evening. In that text, you can also remind me to give you the videos of the previous classes. Okay? So I hope for the new students, at least you are benefiting today, being a last class. Somebody can also comment. John has commented. He is just there to listen to the class, but not to sit for the exams. So, but I think I've mentioned all you need to know. That's my contact. The timings of the classes I've mentioned. How much we are charging. We accept payments in installments. I've also told you we are doing financial reporting of the intermediate. I've given you the timings. We are also doing financial accounting of ATD and foundations. If you have your friends, I've also requested that you go to the YouTube and subscribe. Go to the YouTube and subscribe so that you can get notification for the videos that are posted. Thank you. Is it Killan? Killan. We say thank you. Rich content. Sir, thank you. So see you next time. Our next class is on Wednesday. See you next time. Otherwise, have a good night. We can't do anything now. We can continue from there next time. By the way, I hope the loud was sound and clear. Was the sound loud and clear? Somebody, especially a new student, tell me. Especially a new student, I want to hear the comment. Was the sound loud and clear? Loud and clear. Sometimes it is clear but low. Is the sound loud and clear? I want to hear from a new students. Perfect. Thank you. Perfect. Sawa sawa. Okay, have a good night. Have a good night. So we are hoping that you will join us. Yes, was the best and the best quality video too. Sawa. Thank you. Thank you. Okay, see you next time. For those who will join us, welcome. Have a good night. Bye. If you want to watch the video again, you can still go back to the group. Go back to the link. It will still open. Or go to the YouTube. It's a public video now. Good night. See you. Good night, everyone. Bye.